Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about frequent retirement investment mistakes that we see in our office. Many times we'll talk to people who come into the office and they want to interview us. We want to interview them to see if they're a good fit with our company and we're a good fit for them. And many times when we sit through the fact-finding meetings, we'll uncover some of these mistakes. And this is typically one of our more popular radio shows. We have a lot of comments coming from people. They enjoy hearing and learning about mistakes, so hopefully they don't make them. But we've got a number of them here that Tyler and I outlined. And the first one we're going to talk about is holding too much employer stock, most importantly while you're working. There are certain employers around here, in addition to their 401k, which has a number of mutual fund holdings, they also have the ability to buy corporate stock. And sometimes we see people looking to retire and they're carrying so much corporate stock that if the stock deviates a couple of percentage points up or down, they're going to win or lose substantially. So, we look at holding corporate stock a lot like we do when you are retired and you have a basket of investments in your portfolio. We want to stay diversified. So many times looking at corporate stocks in a 401k, we want to try to pull back a little bit. There's a good mix. Tyler, what else do we see when it comes to the corporate stocks in a 401k?
Yeah, so with the first retirement investing mistake that we see, as you said, Dean, is holding too much employer stock. So there's quite a few companies in our area that do offer employer stock. Now, not all companies within your 401k offer that, so some people don't even have to worry about that. But others have a lot of these large corporations, and they do offer you the opportunity to buy employer stock. And again, a mistake is holding too much of that. And it's common among people who are younger or people who haven't saved enough and are looking to catch up by investing more aggressively. Those are kind of the two scenarios that we see people holding too much of their employer stock. Now, it's important to note that we think it is important to hold some employer stock within your retirement account if they offer it, of course, depending on how you feel about your company. So we're not saying don't hold any at all, because we're actually advocates of that, especially if you feel good about your company. It is nice to hold that employer stock as well. But on the flip side, we've seen people come into our office and they're working right now. They have a 401k at WEC or Procter & Gamble, for example. Those are two of them. And we've had people who they've held upwards of 90% of their 401k in employer stock. So almost the whole entire thing is held solely in one stock. People might have $100,000, $200,000, $300,000, $400,000, $500,000 all in one stock. And obviously you don't want to do that. Instead, you want to diversify and have a mix of different funds based on your risk tolerance in addition to holding that employer stock. Just because no matter how stable you perceive the company to be, no matter how good the company is, how fundamentally sound your company is that you work for, it doesn't matter, because individual stocks, they're the riskiest asset class there is. So if the market in general as a whole, if we were to have a big market downturn, doesn't matter how good the company is, single stocks are going to be impacted the most. So even Procter & Gamble, WEC stock, they're going to feel it if we have a big market downturn like we did at the end of 2018.
That's right, Tyler. And one other thing too is, as Tyler said, we saw some 401k statements where people are holding, 90% of their holdings in their company stock. The question we asked them is, if you didn't have this 401k and you were retired and you had an independent IRA, would you feel comfortable holding 100% or 90% of your holdings in one stock? And usually the answer is absolutely not. Well, we look at it the same way then. Even though you're working for that company, that is very, very risky to take and put 90 to 100% of your 401k holdings in that stock.
Exactly. Good point there, Dean. But ultimately what it comes down to is you wouldn't want your life's savings, which is it's essentially what your 401k is. You wouldn't want that to be dependent upon the strength and performance of one company. So therefore, if you can diversify, if you can go and in addition to holding employer stock, if you can diversify and have different mutual funds in there as well, that would be the better bet for you over the long term. And again, we're not saying don't hold any, because we do recommend holding employer stock, but at the same time, you don't want your whole thing in employer stock. So first investing mistake that we see when it comes to retirement investing, holding too much employer stock.
Okay, the next one we're going to talk about is being too conservative with your retirement investments. You've heard us talk about this in the past with past shows, and that is we are an advocate of getting safer as you get older with some of your retirement funds. Part of the reason is you go through this phenomena called no more payroll once you retire. That payroll doesn't come in every other week and get you out of a market trough by dollar cost averaging in your 401k. So what happens in a situation like this is, yes, we would like to see some of your retirement funds put into safer havens at this particular time. And notice I didn't say more conservative. I said safer havens. And what I mean by that is some cash positions. We like to see some laddered CDs if that's the case. And maybe fixed annuities, just a standard fixed rate annuity, things like that, treasuries. Part of the reason is we also believe in the 3-bucket approach. You need to have safety, which we establish first, income producing investments or retirement accounts, and then growth producing investments and retirement accounts. So again, as you get older or in retirement, we'd like to see those 3 buckets. We'd like to see safety, income, and growth. So again, people will say they're becoming more conservative, so therefore their retirement account is safe. Doesn't always equal, okay? Conservative could be a bond position, and you can take a significant risk with bonds. So understand, conservative does not mean safe. The other thing too is if you get too conservative with your investments in retirement, many times you can't keep up with inflation. So Tyler, let's talk a little bit about some of those situations where people become a little bit too conservative once they retire.
Yeah, so that, again, it's very common that we see this where many people think that once they head into retirement, they automatically need to shift their whole portfolio into something more conservative like bonds, CDs, and money market positions. And if you were to do so, you would reduce your risk and you would reduce the volatility that your account sees. So by going into things like bonds, CDs, money market accounts, you wouldn't see the overall volatility of the stock market, which is, you do want that, but at the same time, you also would reduce your growth potential substantially as well if you completely shift everything to conservative investments. And then at that time, you would run the risk of losing out to inflation. So what I mean by that is, okay, if you're in different bonds, CDs, money market positions, you might average, 1, 2, 3, maybe 4% per year. But depending on what inflation is, if you're averaging 2% and inflation is running at 3%, then sure, on paper, on your statements, it shows that you're making money. But when the prices of goods and services over time are going up by more than what you're making percentage-wise, then you're actually losing out to inflation. And over time, you don't have the investments working for you to keep up with inflation over the long run. So when that happens, even though you might be earning interest on your money, at the same time, inflation could be growing by more than what you're earning. Therefore, over time, you're actually losing in a way. And in addition to that, once you start to withdraw from your account, so in retirement, you flip the switch the other way, because when you were working, you went from saving all these years, but now all of a sudden retirement comes around and you have to start taking the money out, withdrawing it, and then spending it to help with your Social Security, or maybe you have a pension to help live on. And then you could potentially run out of money once you start taking withdrawals in retirement if you're not positioned correctly, if you're too conservatively. Because again, if your investments make 2% per year, but you're withdrawing 8% of the value, then over time, they're going to run out unless you have a portion that's used for more growth potential. Because stocks, those are used for growth potential. Now, again, they're going to be more volatile than bonds, CDs, money market positions. So you want to have balance. You don't want to have everything in stocks, but you don't want to have everything in conservative positions either. But at the same time, if you do shift at least a portion over into stocks and stock funds, then over time that can help you outpace inflation, and it could potentially help you sustain your accounts and your withdrawals longer, therefore reducing the risk of running out of money as you continue to get further and further into retirement. So being too conservative with your retirement investments, that's a retirement investing mistake that we see. What we recommend is looking at a balanced portfolio where you do want to have conservative investments within your retirement accounts as you head into retirement, but you also want to have a portion that can be used for growth as well.
Okay, good points, Tyler. The next one we're going to talk about is not understanding the fees you're paying within your investments. Now, I said within your investments, there are typically advisory fees, which are usually on a statement that shows what your advisor is being paid. However, many times you're not aware that your investments also spin off some fees. They have some expenses there, so some fees either go to the mutual fund company or the advisory firm. They're in the form of a term called 12B1 fees or management fees. Also, there are different types of investments that have more fees internally than others. And Tyler and I explained this to investors. You know, there are mutual funds which usually do have internal fees. Could be pretty high, could be very efficient depending on the company and the type of mutual fund. Those are internal fees, again, that go back to the management of the fund managers, whether it's American funds or whatever company has them out there. But then there are also different types of structures that are typically known for higher fees. For instance, fixed annuities are usually known for higher internal fees. That's just one of their characteristics. It's very important to understand that, though, because, again, if you are in something that has substantial internal fees and you have selections that are relatively conservative within that investment that generate 2 or 3% gain on a good year, like some bond positions, but yet you're paying 3% expense, you're not going to win that game. Okay, so what's going to happen is you need to understand your fees. You also need to understand your fees when it comes down to actively managed accounts versus passive managed accounts, because it's very easy to look at a statement from advisory firms and the client will say, well, I'm paying 1% for my advisor. And then you look at the statement and you look at the holdings and you say, well, you're paying 1% to your advisor, but the internal fees of your investments are spinning off, let's say, 1.5%. So now you have 2.5% total fee structure. So make sure if you're dealing with your advisor, come right out and explain the fee structure. Is it an advisory fee? Do you have internal fees? What are the 12B1 fees? What are the maintenance fees? Do you have fees for transactions? Am I in a brokerage account where I don't have that? Do I have investments that generate fees? Tyler, I'm going off on a tangent here. What else do we want to explain when it comes to fees?
Yeah, almost all investments charge some sort of fee, so there's really no way of completely getting around paying fees, but it is important to understand what the fees are that you're paying within your current accounts. And we see some clients, they come into our office with a certain type of investment that they were put into some time back, and they said, you know, the market's been up for 10 straight years now. Why isn't my account performing well? They haven't made any money in a number of years. Come to find out that they have internal fees within their particular investment upwards of 4%, meaning that they would have to average 4% per year in growth just to break even. So it's important to realize, even if the market's doing well and even if you have decent internal investments within a type of investment that you have, you still might not be doing well just because the fees could be dragging it down. So again, that's why it's important to understand exactly what the fees are that you're paying. Now, one thing that you can do, whether it's within your 401k, if you have an IRA that has, you know, different mutual funds, ETFs, bond funds, or if you have an annuity, One thing that you can do is you can go to, there's a bunch of information on public websites out there, especially when it comes to mutual funds, which are very common in everyone's 401ks. You can look at something called the expense ratio, which that details the internal fees that you're paying that you don't even see come out of the account. You can go to websites like Yahoo Finance or Morningstar are two of the ones that are publicly available that we use, and that details the internal fees that you pay each year. So that's something that you can do, again, whether it's within your 401k or an IRA, to look and see what the internal fees are. If you have an annuity, then you should have a physical policy or a prospectus that you can look at, and that details the fee breakdown and the fee structure within there. But again, just very important to understand the fees that you're paying within your investments. That helps you make good decisions when it comes to choosing the right investments.
Okay. We're going to take a quick break here, and then we'll come back and talk about some more mistakes that we see.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, the next one we're going to talk about are some of the cliches that we hear a lot of times. We'll have people come into the office, and if we had a dime for every time we hear these cliches, we'd be making pretty good money just from that. But one example that we hear a lot is people come in and say, I can't retire unless I have $1 million. We hear that one a lot. We actually see some people on TV and some of the celebrities out there saying that. We've read it out there, and we totally disagree with it. And part of the reason is you have to know your own situation. You have to know that client's situation. You have to know their debt. We have clients that have substantially less than that and have no debt, and their living standard is not going to change at all from the time they're working into retirement because they've taken care of their debt situation. So you look at that. So you really need to know the client. You also have to look at it and say, first of all, how long do you plan on working? Because there's probably no chance of you making that number if you haven't started early, okay? And you will retire. Whether you know it or not, you're going to retire someday. Your employer might say you're too old, okay? I mean, we're going to hire somebody younger. They're not going to say it that way, but that's really the bottom line. Or your body starts to fail. So there are certain things, and the number one that we hear cliche is you need $1 million. Tyler, let's talk about a couple other cliches we hear quite often and, dispel, some of the myths around them.
Yeah. Another one of the oldest ones is one of the oldest investment cliches tells you to allocate your investments based on or between stocks and bonds in relation to your age. So what I mean by that is, for example, an old investment strategy is to take the number 100 minus your age, and that's the percentage of the funds that you should have in stocks. So if you take 100 and if you're 30 years old, 100 minus 30, then 70% should be in stocks and 30% should be in bonds or fixed investments. On the flip side, if you're 80 years old, 100 minus 80, then that would mean 20% should be in stocks and 80% should be in bonds, CDs, annuities, money market accounts, different fixed positions. And while that might work for some, it's a one-size-fits-all approach, and it might not be correct for everyone because that strategy assumes that everyone at the age of 50, 55, 60, 65 should have the same exact investment strategy, but that doesn't take into account a number of other factors, such as if you're working or retired. So if you're planning on working until 70, you probably don't need to be as conservative as soon as someone who is planning on retiring at 55 years old. Another thing would be your health, your family health history. If you have longevity on your side, then you might need to stay invested relatively more aggressively for a longer time period. Just because you're going to be living as long, you don't want to outlive your money. In addition to that, your fixed income. So some people have very big pensions that they get per month. Some people have very robust Social Security benefits that they get as well. If that's the case, they might be able to afford to be a little more aggressive and have a little bit more in stocks for longer as well. A couple other things, your individual risk tolerance and your liquidity needs. So that approach works for some people, but other people, they might not have the risk tolerance, even if they're younger, to have that much in stocks, or if they get older, they might want to have more in stocks. So again, it's all based on whatever your individual situation is. That's what's going to matter. And in today's day and age as well, taking 100 minus your age and allocating that number to stocks, it might actually be a little bit too conservative for many people, simply based upon longevity and people living longer, meaning that you could again run into that inflation risk by becoming too conservative too soon with your retirement fund. So again, we see a lot of different investment cliches. The number 100 minus your age in terms of how much you should have in stocks. It's a one-size-fits-all approach that might not work for everyone. And as you said too, Dean, the needing $1 million to retire, that's not true at all either. So there's many of them out there. It's important that you don't act on investment cliches, but more importantly, get a financial plan for yourself, because that's going to detail exactly what you need, not what someone else tells you that you need, not knowing your situation.
Okay, good points, Tyler. The next one we're going to talk about is mismanaging your withdrawals in retirement. This is a big one. People don't realize the tax implications or other implications that you run into when you just randomly go start withdrawing from an account. If you are retired and you need to start generating income, which that's why you worked your whole life and put money away so you could have money in retirement, you're going to trigger things like your Social Security. If you have a pension, that is going to be triggered and start to pay you. And then you might have some IRAs that were created through 401k rollovers or 403b rollovers. You need to sit down with a tax advisor and a financial advisor and find out, are some better suited than others for withdrawals? For instance, you need to know also where to withdraw from if you are getting your health insurance on the Affordable Care Act, the exchange. Part of the reason is that's built 100% based on income. And if you have a non-qualified brokerage account or you have some cash positions and you retire and start pulling from them, the cash positions, the Roth positions, some of the non-qualified money shows as zero income. So therefore, you can keep your premiums substantially lower based on them showing up as zero income. And you're going to be much happier with a lower premium. If you don't pay attention to this or don't know this or don't have some advice from a financial advisor or a tax preparer or a tax consultant, what happens is you could start taking your money from Social Security and then maybe jump into taking money from your IRA, thinking that you need to keep all that cash there. Well, what happens is your IRA is going to be reported as fully as income, as well as your Social Security. Unfortunately, your health insurance premiums are going to go up compared to the first scenario I gave you. So you need to know that. Tyler, what else do we look at when people are withdrawing their money?
Yeah, now what we find is oftentimes people have a hard time transitioning from saving to spending when it comes to being retired, because all these years you're used to saving up within your 401k, you're told to save, but then suddenly when you retire and you no longer have that money coming in through payroll, you've got to start spending what you've saved up all these years within your retirement account. And we see people fall on both ends of the spectrum, where some people take too much out of their retirement accounts early in their retirement, and therefore they risk running out of money in their later years. But on the opposite end, there's people that are sometimes a little bit too stingy with their withdrawals, and they might be cheating themselves out of enjoyable things in retirement like vacation and travel, a new car, vacation home, different things like that. So the trick is trying to find a strategy that will allow you to enjoy your retirement, vacation, travel, get new things, but at the same time, not take out too much too soon to worry about running out of money later on down the road when you might need it the most. So the main way to combat withdrawal mistakes is to sit down and formulate a game plan so you know exactly how much you can plan on taking throughout your retirement without having to worry about running out of money, which no one wants to worry about that in retirement. So sit down, formulate that game plan. We help our clients all the time by plugging their information into a financial plan and determining if they take a certain amount each and every year, will their money last? In addition to that, another thing you can do is make sure that your investments are coordinated correctly with your withdrawal rate. And what I mean by that is if you're withdrawing your portfolio down at 10% per year, if you're taking 10% of the value per year in income, well, then you better have relatively aggressive investments within your account to try and replenish that over time. Because if you're taking 10% per year, and going back to my old example, and you have all conservative investments that are only making 2 or 3%, then eventually you're going to run out of money over the long term. And on the flip side, if you're only withdrawing, 2, 3, 4% of your account value in retirement and you have very aggressive investments, you probably don't need that. You're probably taking on too much risk. So you want to also make sure that your investments are aligned with the withdrawal rate and how much you're taking out as well.
Okay, good points, Ty. What we're going to talk about next, a mistake that can be severe at times, is trying to time the market. Especially when the market is at a high like we are here in 2019, we'll hear a lot of people say, "Well, I would like to invest additional money, but I'm going to wait until there's a market decline." Well, first of all, trying to time the market, there are studies out there that show that if you miss some of the peak parts of the market over the last 20 years, how much your portfolio would be versus if you just dollar cost average and go in there. And typically, if you dollar cost average, you're going to find out that you're probably better off. So trying to time the market is not a good move at all. Now, that's not to say that if you're looking to invest, you dump it all in on one particular day in 1 hour. There's nothing wrong with staging it a lot like dollar cost averaging over the course of 2 or 3 months, just so you can pick up some. But you're also going to pick up days that the market is higher too. But we just talked about cliches. Not to hang on to cliches as an investor. But one of the cliches out there when we're talking about trying to time the market is we like to see time in the market, not timing the market. So, Tyler, what else do we see when it comes to people making mistakes trying to time the market?
Yeah, Dean. So obviously this is a bigger one that we see a lot, where people try and time the market, and it could be everything from trying to contribute, trying to invest at a low point, or trying to sell off investments at a high point, which is what everyone wants to do. You want to buy low, sell high, but in reality, no one can do that on the exact low point or the exact high point every single time. So, like you mentioned, Dean, dollar cost averaging is the best, where you invest a certain dollar amount every single month, or when you're taking withdrawals, you take withdrawals out the same time every single month over the long term. That will average out and be your best bet. But ultimately, when it comes to retirement investing, because that's what we're talking about, investing for retirement and the mistakes that we see, it's very important to realize that having a long-term approach is going to be the most important. And as you mentioned, Dean, it's about time in the market, not timing the market, because your retirement accounts, they need to last for your lifetime, and making drastic changes based on short-term market conditions can throw off your whole entire retirement plan. So important to realize that when it comes to retirement accounts, they need to last your lifetime. You want to have a long-term approach and a long-term perspective for your retirement accounts. Trying to time the market is never a good thing.
Okay, good show, Tyler. That's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.